Following on from the live webinar this week, we're going to continue on with IFRS 15, revenue from contracts with customers. Where we stopped off in the live webinar, we were looking at this whole idea of variable consideration. And we said one good example of that you'll see in a lot of companies is sale of products with a right of return. So that when you sell a product and the customer has a right to return, you should only recognize the revenue of the products that you expect to be entitled to. So what we mean by that is you shouldn't recognize revenue with respect to products you expect to be returned. They should be recognized separately and they should have a separate journal entry. So we'll show you that now in a little example to show you how it distinguishes between true revenue, which can be recognized, and then money received from customers, which is actually expected to be refunded through a right of return. So just put up these side by side. So company X sells laptops for €1,000 each, and they sold 100 laptops in this period. They cost 600, so you're making €400 profit on each laptop, and the terms of sale is a right of return of 30 days. And they estimate 3 laptops will be returned based on historical sales patterns. How should the retailer record the revenue and the expected returns? So the first thing is they're receiving 100 times 1,000. So they are getting money in of 100 times 1,000, which is 100,000. So that's how much money they're receiving in. Because they're still being paid. They made the sales, they get the money in. So it's 100,000. Let's tidy up that. But of that, be careful, you're going to credit revenue 97,000. You're going to credit revenue for the 97 laptops that you expect not to be returned. You're then going to credit what they call a refund liability. That'll be current liability, and you'll debit bank the 100,000. So that's a key distinction in IFRS 15. It says for any money you receive, which you expect to have to return, you're going to credit a refund liability. You don't credit revenue. So you only credit revenue, the net amount of which you expect to receive after any returns are accounted for. The other thing is to note there's a related issue here is what about the cost of those laptops? Well, in this case, you're going to debit cost of sales 97 times 600, which is 58,200. So 97 laptops compared to the 97 from revenue. You're then going to debit right of return asset. And that's going to be 3 times 600, which is 1,800. Now that goes to inventory. It's a current asset, it goes to inventory, and it's something new that we wouldn't have had before. You're essentially saying, well, if I do pay this refund liability, I am going to get these assets back because they have to be returned. So that means they're going to be an asset. If I haven't written off the cost of sales, and then you'll credit your purchases. Some people might say credit inventory, it just depends. You can go credit purchase or inventory, depending on what way the accounting is set up. 1,000 times 600. Sorry, 100 times 600, 60,000. So what we're saying here is when you're recognizing the revenue, you match the cost associated with it. So you only put the cost of sales, 97 cost of laptop. The other 3, they're not recognized. There's a refund liability because you expect to have to pay the money back when they're returned. But when they are returned, you're expected going to get an asset in for the 3 laptops because they're going to come back into inventory. So this is part of inventory. It will be shown in inventory and current assets. We often just call it right of return asset when we're talking about an IFRS 15 to make it clear for tutorial purposes. And then you will credit your purchase or inventory to say, well, you bought 100 laptops to 600 each. Some of them are going to cost of sales. Some of them are staying in inventory at the year end. Right. So again, there's a bit of a difference there, and you'll see 1 or 2 examples in the question pack as well. It's not overly technical, but it's just important to understand that you don't recognize the full 100 laptops revenue. Even though you've sold 100, there is a right of return, and you use your best estimate based on what the historical sales patterns were to account for that refund liability and associated right of return asset. So the next thing, once we've ideated what the transaction price is, and we've dealt with variable consideration, etc., is, well, we need to take that transaction price and allocate it to the relevant performance obligations. The usual way we do this is we refer to standalone selling prices. So in the case of the mobile phone contract we mentioned in class, you'll get the standalone price of the handset, the standalone price of access to the network without the handset, and you'd allocate that pro rata then, whatever proportion for the bundle price. Now, if they're not available in terms of standalone prices, you can use adjusted market prices, expected cost plus a margin, or whatever's left over, a residual approach. Now, these are not advisable or preferred under IFRS 15. If you can, you're looking for standalone selling prices. There are alternatives. Don't worry them too much about AC220. You'll only ever be given standalone selling prices. In terms of giving an idea, or for example, you might be given a forecasted expected cost, and then you add on an appropriate margin. That'll give you a good idea of how to allocate the price. But generally what you're trying to do is you're trying to quantify what would these be worth on a standalone basis in terms of deliverables. And because they're bundled together, they're probably at a discount overall. So you allocate it pro rata. Now what that means is we'll see it in an example. It's probably the easiest thing. At the end of year 2, an entity sells a bundled product with a 2-year service warranty for 9,000. The separate price of the product was 8,000, and the separate price of the warranty, if you bought it without the product, is 3,000. So we can see here, if you bought them standalone, they'd cost 11,000. Whereas when you buy them together as a bundle, they cost 9,000. Now the question is, how do you account for it in year 2, and how do you account for it in year 3? Right? Because you can't just take the 9,000 alone. There's 2 separate performance obligations there. One is to sell the product. The other is to offer the service, the warranty. Right? So the product and the warranty are separate, and we need to quantify them separately to account for them separately. So the first thing you do is you look at the standalone selling prices, which are given. So that is 11,000 overall. They are the standalone selling prices. To that, what you do is you get the proportion. So of the total, the product is 8 over 11. The product represents 72.7%. The warranty represents 3 over 11, which represents 27.3%. And you take those pro rata and then you allocate the transaction price. So we'll skip year 2 and year 3 for a second. You take the product and the warranty. We know the transaction price overall is 9,000. That's what we're given in the question. The standalone, that's just for allocation purposes. What we now say is, well, that means if the product of the bundle is worth 72%, you say 9,000 times 72%. You will recognize the product as 6,500. So even though the product standalone is worth 8, because you've given a discount, it's going to be worth less. So it's now going to be worth 6,500. The warranty is going to be worth 9 times 27.3, which is 2,454. And those added together get you to your 9,000. So what we've done there is we've taken the standalone prices, used those as the basis to get what proportion each of them are in the bundle, and allocate that to the 9,000. The product can be recognized when sold, i.e. year 2. So that can be recognized at a point in time when it's sold. When you sell a product, it's when you transfer the risk and reward of ownership to the customer, which is when the product is sold. The warranty is recognized over the 2 years, i.e. year 2 and year 3. So that's a distinction. The warranty is going to be recognized over 2 years because it's a 2-year warranty. So you'll recognize half of it in year 2 and half of it in Y3. So it's a difference. That's why we separate out performance obligations, because in each of them, they have their own recognition criteria. Sometimes when you're selling goods, you'll recognize it when the good is sold over, because the risk and reward of ownership transfer at that date, and the revenue has been earned. Whereas for the warranty here, you only earn that revenue over the 2 years as you provide the warranty as the time goes on. So in year 2, the journal entries, what will it be? It's going to be debit bank. We'll assume we got paid 9,000. Otherwise, it'd be debit trade receivables. You're going to credit revenue for the product 6545. You can recognize that up front because when you sell a product, you recognize it at the date of transfer. You're going to credit revenue for the warranty. Be careful, 2455 divided by 2. Why? Divide by 2 because it's over 2 years. 1 year is year 2, the other year is year 3. And what you're going to do, the last one, credit deferred income or deferred revenue, and that will be a current liability. To say you have been paid for it, but you have not received it yet, another 1227. Now, there's a bit of rounding there, but that's fine. So what we're seeing here is you have to defer the recognition of revenue for the second year of the service warranty until it's actually earned. And you'll only earn that next year when the time passes, that second year of the contract. So in year 3, you will debit deferred revenue and you will credit revenue for the warranty. So it goes from a liability to a revenue, the P&L, 1227. And that's what the key accounting is. So that's what we call a bundle of goods, where you split them out. You identify the distinct performance obligations, otherwise known as the distinct promises. You promise here to do 2 things: give the customer a product straight away, and then give the customer a 2-year warranty related to that. So that means you will defer the recognition of 1 year of that warranty until next year. So that's a common question you'll see in some exam papers, is the bundling of goods. Firstly, unbundling them using the standalone prices. And the second thing then is to account for them in the current year and maybe where they go as well. So if you get money in from customers that you have not earned yet, we call that deferred revenue. And that means that will be up as a current liability if it's within the next year, or a non-current liability if you don't expect it to earn. Maybe it could be a 3 or 4 year service warranty, then some portion of that will be non-current as well. But because we've only a 2 year here, all of the rest of the warranty will be earned in the next year, in year 3. So it can all go into current liabilities. There's a bit of a trickier one where you're dealing with bundled discounts, unbundling them and accounting for them. And that then leads on to step 5, is the recognition of revenue. So once you've determined the transaction price, allocated that price to each of the performance obligations, you then recognize the revenue, either at a point in time or over a point in time. So at a point in time for the transfer of goods, you recognize the revenue over a period of time when it services. So for example, provision of warranty service, provision of a mobile phone contract service, they're all recognized over a period of time. But that's just why we separate them out, because they're kind of different treatments. Right. How you measure the progress. Now, this is one thing to note here, is we're not looking at IFRS 15 in the context of construction contracts. That'll be something you look at next year, which replaced IAS 11. And we have long-term construction contracts. But you can measure progress in terms of if you've some performance obligation that needs to be recognized over a period of time. You can say, well, I'm going to recognize it based on the output, based on how many months are gone, or how many milestones have been achieved, or maybe input based on how much costs have incurred or labour hours. Probably more relevant when you're dealing with construction contracts, which you will deal with next year in IFRS 15. We're just looking at pure revenue contracts for this year. And again, that just gives you an idea of how you approach it. So when a performance obligation is not satisfied over time, control is transferred at a point in time. And typically when we're looking at when does control transfer, you're looking at some of these key characteristics. Right? Has a legal title transferred? Has the physical possession of it transferred? Has the risks or reward of ownership transferred? So when you're talking about the transfer of goods, you're thinking about at a point in time. And what you have to determine is, when is that point? Is it on delivery? Is it on ordering? And you're looking for these key rules to see when it happens. When does the legal title of the goods transfer? When does the present right to payment transfer? When is the physical possession? When is the actual delivery transferred? And when are the significant risks of ownership, such as theft, the risk of it being damaged, the risk of it going obsolete? When does that transfer to the customer? When all of those the majority of them happen, then you know you can recognize the revenue from that product sale. Right, so it's just giving you a key idea of the 5 key steps from the determining the contract to determining the performance obligations, getting the transfer price or the transaction price, should I say, allocating that price to each performance obligation, and then recognizing the revenue for each performance obligation. Right, so there is a bit involved there, and it takes a bit of practice. Certainly go back and read chapter 4 in the Kieran Connolly 6th edition, available in ebook format, and have a look at the question pack as well. Some good questions to practice and exam level ones as well. So there's two other small considerations, additional considerations we want to take a look at in IFRS 15, and they deal with warranties and consignment agreements. Now, they're practical considerations you'll come across in the real world that IFRS 15 has to deal with, because again, they're important ones that can result in implications for your revenue line item. The first one is your warranties. Now, warranties is a typical thing you might give with a product that you sell. You're saying, I guarantee it, I'll give a warranty for maybe 2 years or 3 years. However, IFRS 15 draws a distinction between warranties that a customer can purchase separately, like an extended warranty, or warranty that you cannot purchase separately, like a normal warranty you get for a year based on your consumer rights. So a service warranty, these provide a service to the customer. They typically extend the normal warranty period, and it's a distinct service and therefore a distinct performance obligation. So that means you're going to be having a bundle. Like we talked about a bit earlier, you're going to have to unbundle this service warranty from the underlying product itself. Now, the key thing to distinguish a service warranty is that it offers something that is separate to the underlying product. That you can buy the service warranty. You'll often go into shops and say, do you want to buy an extended 3-year warranty? Or you can have the normal 1 year that comes with it anyway. That extra 2-year warranty, that's a service type warranty. The assurance type warranty, as the name suggests, it gives you assurance. So it promises a customer that the delivered product is specified as contract. It doesn't give an additional good or service. It's not a separate obligation. So accounting for this warranty isn't a separate performance obligation. You don't need to unbundle it. You account for that as an obligation under IAS 37. So your expectation of the cost of satisfying the warranty, is it a present obligation from a past event, and can it be reliably estimated? So that's a key difference in IFRS 15 from the previous standards, was they drew that distinction between the service and the assurance type warranties. Right? So the key thing here, whether a warranty is a service or not, you'll figure out, is it required by law? Well, if it is required by law, for example, the Customer Supply Goods and Services Act, well then it's not a separate performance obligation. It's more likely to be an assurance type warranty. The longer the warranty is, the more likely it is a service type warranty, that you're giving them extra warranty over and above what's required. And the nature of the tasks. Right? So if it's necessary for the entity to perform specialized tasks to ensure conformance specification, it likely does not rise with a performance obligation. Right, so what does the task that the entity promises to perform? The more specialized they are, the less likely that's a service warranty, because it's part of the original bundle. It's part of the original product, and therefore you wouldn't have to separate it out in IFRS 15. There's a nice little flow chart here. Does the customer have the option to purchase the warrant separately? Yes, then it's clearly a service type warranty. Why? Because it's an additional performance obligation. Does the warranty or part of the warranty provide customer with a service in addition to the assurance that the product applies with the specifications? If it does, you're into the bundle. If not, you're into IAS 37. And that's a key distinction, because there's completely different accounting for both of them in terms of what's recognized in revenue and what is just recognized as a provision. I think the easiest way to look at this is look at an example and see how it works out. So we're going to put this example side by side with the solution. So an entity sells a 2-year extended warranty. That's the key word there, extended, for €3,000. Standalone selling price for the product is 2.5, and the extended warranty is 500. So actually they've given no discount here. It's just the full amount of the two standalone. The product automatically comes with a 1-year warranty guaranteeing any product defects. At the end of year 1, cash sales, the product warranty bundle, are 150,000, and all of these sales still fall within the 1-year assurance period. The entity estimates that 10% of total sales will be returned for some level of repair, So not returned to get the money back, but for repair in the first year of the warranty. The expected cost of each unit repair is 400. Prepare the appropriate journal entries for year 1. Well, the first thing here is we have a bundle, and it's a bundle between the product and the service warranty, or if you want to call it there, the extended warranty. That extended warranty is a standalone piece over and above the first year. So that's 2.5 and 3 and 500. So actually there's no need to figure out the pro rata here because there's no discount. The two standalone values happen to be the exact same as the overall. If that, for example, was 2.7, then you'd have to get the pro rata amounts and allocate the 2.7 down. Because it's the exact same here, that's the amount of money attributed to the product. That's the amount of money attributable to the extended warranty. Right? So what we'll do at the end of year 1, you're going to credit revenue for the product to 5. That's fairly straightforward because you're crediting the revenue because once you sell the product, risk and reward of transfer have passed, so you can recognize the revenue. Right? Now be careful, 2.5 what I've done there, that's only for one unit. You've sold 150,000. So 150,000 divided by 3,000 is 50 contracts. Or you say 50 bundles have been sold. So in that case, it is 50 times 2.5. So you're recognizing 125,000 because that's the sales for year 1. You're going to debit bank 150 because you're told they're all for cash. And that means we have, in this case, 50 times 500. We have 25,000 euro attributable to here, the extended warranty. Now, what I'm going to assume is all these sales took place the 1st of January. So the whole first year is used. Probably not realistic. So it might be easier actually, might be better we assume that they're sold pro rata halfway during the year. So it makes it a bit easier. So you're going to credit deferred revenue, current liability, and you're going to credit deferred revenue, non-current liability. So we're trying to say, remember, the extended warranty is not for the first year. The first year goes with the normal warranty. It's the year and 2 years after that, year 2 and year 3, what you're dealing with. So in current liabilities, we're going to say there 25,000 divided by 2, because it's a 2-year extended warranty, times 6 over 12, 6250, and the rest will be non-current. Now that's tricky, but what I'm assuming here, assuming all sales occurred evenly throughout year 1. So that means, so it means on average you're going to have, say, a sales date of the 1st of July. So that means 6 months on average of 1-year warranty is used. So we're saying if this occur evenly throughout the year, you're saying on average 6 months of this traditional 1-year assurance warranty is used. So in year 2, and this again is all on average because you're not looking at each contract. On average, first 6 months covered by normal warranty. Second 6 months covered by extended warranty. Right? That's the key thing we had to do there. It was a bit tricky here because we weren't told when the sales were made. We're told they're just made throughout the year. So if we assume they were made halfway during the year, or on average they occurred halfway during the year, some were before halfway, some were after, then we're assuming 6 months of the year 1 warranty was used. So the next 6 months between January and December year 2 will use up the rest of the 1-year warranty. After that then, and this is we're talking about 6 months in year 2, we'll use up that. And then you're using all year 3 plus 6 months in year 4. Now, I know you're saying, why are you going into year 4? Because we're assuming not all those sales were made in the first of the first year 1. They could have been made right throughout year 1. And when the sale is made, it's from that period on that the warranty occurs. If this was the 1st of January year 1 the sales were made, it'd be very straightforward. So it just gets a bit more complicated the further out you go, right? And we're just looking at average and saying, well, assume on average the 1st of July was the sale of this bundle, 150,000. Some of them might have been before, some of them might have been after, but on average, the 1st of July. And that means then 6 months will be covered. Now, 6 months will be covered in year 2. That's for the traditional warranty. So the extended warranty only comes in after that, which will be year 2, year 3, and a bit of year 4. That's a bit more complicated now, more an exam level question when you're dealing with the practicalities of when the sales actually take place. For the other one, the assurance warranty, you're going to debit the SOPL and credit the warranty provision, which will be a current liability. And you're going to recognize that to be, you're told here 10% of sales will be returned and a 500 unit. So we know there's 50 bundles sold. So 50 times 400 is 20,000. So be careful, I should take 10% of that then, because of course you only expect 10%. So if there's 50 bundles sold, you expect 10% will be returned for repair. Not that they're returned to get a refund, they're only returned for repair under the warranty. So that means there's going to be 5 bundles, 10%, and 5 bundles at €400 each is 2,000. All right, so that's important that you read it carefully. When you have an assurance type warranty, it's accounted for under IAS 37. You have a present obligation from a past event. You made the sale, you offered the warranty. It's probable, because again, you expect 10% to come back, and you can reliably estimate it. So that would fall under IAS 37. So this is an extended warranty. It's a separate product completely, and you can attach a separate price to it. The normal 1-year warranty isn't typically seen as a separate performance obligation. It's part and parcel of the overall product. So that means you will treat it as an IAS 37 warranty, which is called an assurance warranty under IFRS 15. So again, it's all about terminology, just getting used to that, and particularly the debits and credits as well. The other little complication we have is this whole idea of consignment arrangements. So the whole idea of a sell-through approach is common enough today where distributors will not recognize revenue until the product is sold on. And a distributor may be able to return any unsold product or rotate older stock for newer stock. So for example, the seller, the retailer, doesn't really take the risk or reward of ownership. If they don't sell it, they give it back to the supplier. If they do sell it, then they recognize the revenue. So what we often say here is this inventory is on consignment. It's not actually bought, and there's not actually risks involved. It's really sitting there and it will only be sold. You'll only recognize the revenue when it's sold. So no real control has passed to the distributor, which is the retailer. So the key indicators that you're looking for here is the product is controlled by the entity until a sale occurs, which means the supplier can take the product back. They can require return or transfer to a third party if they want to, so they can take the stock back at any time. And the dealer or the retailer does not have an unconditional obligation to pay. So the retailer, like a SuperValu, doesn't have to pay for the product unless it's sold. So that means really the risks and reward of ownership have not transferred, as you don't have a legitimate sale in that case. So take this example is probably the best one to look at it. A manufacturer provides household goods to a retailer. It could be Dunnes, could be Tesco. The manufacturer retains title of the products until they're scanned at the register. And the retailer does not have an obligation to pay until that sale occurs, and any unsold products may be returned. So the retailer has no risk here. If they don't sell them, they can send them back. They don't have to pay them until they sell them, so there's no risk involved. And likewise, the manufacturer retains the right to call back unsold products. So what we see here is really the manufacturer cannot recognize revenue until the sale takes place. Even though the goods have been transferred from the manufacturer to the retailer, the substance of the transaction is it's not a sale because the retailer doesn't pay until they sell them on. If they don't sell them on, they can send them back, and the manufacturer can take them back at any time as well. So for all intents and purposes here, this sale does not occur until the retailer sells it on to the final customer. So the manufacturer will only recognize revenue once the goods are sold on. So what you can see here, that can be complicated for an audit perspective, because you could have a manufacturer who doesn't have inventory in their warehouse, but technically it's still inventory for them under IFRS 15 and IS2, because it could be on consignment in a retailer. So you're going to have to ask the directors, do you have any consignment arrangements with your retailers? And the converse is, you could have a retailer who has stock at the year end, but it's actually not on their balance sheet because the stock isn't belonging to them. They're holding it on consignment, and it will only be recognized when they sell it on to a third party. That they're not untypical consignment arrangements in the real world. It puts the risk on the manufacturer, but it takes the risk away from the retailer, which might incentivize them to hold more of that stock because they know they don't run the risk of not being able to sell it or it getting stolen, etc. So that's a good example of two practical things: warranties, and the distinction between a service warranty and an assurance warranty, but also consignment arrangements. The other key thing that they require, the IFRS 15 as all standards do, is disclosure. And there's a huge amount of disclosures required, particularly in terms of disaggregation of revenue, splitting revenue out into detail, not just giving a single figure, but splitting it out, for example, here, of different product lines that you have and different geographical regions as well. And that's taken directly from an illustrative example in the standard. They don't just want you to show 11.5 million revenue. They want you to split it by major lines, the segments that you look at, split it by geographics, or they want you to split it by the major service lines that you have. So giving more information to the user of financial statements, where is this revenue coming from? And that's one of the earliest and important notes you'll see in a set of financial statements. For example, we look at the CRH one. It's a very good one to show you how important it is and the detailed level of disclosure that's required in IFRS 15. So for example, if we go back and let's have a look maybe at CRH and we look at their report. So the revenue, you're told, is note 1 and note 2. They have 25 billion of revenue for the year in 2019. So again, that's why we said it's an important one. There's no item that has anywhere near 25 billion. Even their assets aren't 25 billion. So it's the biggest line item of the financial statements. That's why it's hugely important. If you go to their accounting policies, which you see here, and we go down through accounting policies, keep going down. Revenue recognition, see note 1. It tells you the group recognizes revenue in the amount of the price expected to receive from the goods and services supplied at a point in time or over a point in time, as contractual performance obligations are fulfilled. So again, it's all the language around IFRS 15. They tell you how they recognize revenue from sale of goods. They tell you how they recognize revenue from construction contracts, because it's the type of business they are. So it's a huge amount of detail there. Right? And if you go to note 1 and 2 then, which is reference to revenue, we can see note 1, the revenue breakdown, shows you the revenue, the 27 or 28 total group, 28 billion, broken down by the different divisions, the regions, and whether it's discontinued or not. Huge amount of breakdown there. Same here, they break it down by product line. Infrastructure products, cement, DIY, for example, what they sell in each one. All that's required under IFRS 15. And then the segment breakdown of revenue by each of the areas as well. Glambier will do something very similar. Just to show you as an example. Revenue for the year, note 5, they have revenue of 3.8 billion. We'll go to note 5, just briefly. Sorry. So note 5 there, you have your revenue, and you come down. They don't give a breakout here, I think. They might give it an earlier note. So they may not have any materials. So the disaggregation of revenue, see it here? It's actually note 4 in the segment one. They break the revenue, the 3.1 billion, into Europe, international, North America, and they break it across performance nutrition or nutritionals. So a huge amount of breakdown has to be given under IFRS 15. So it's interesting just to have a look at a couple of them. And the model financial statements are probably the best one to show you the reference. So note 5 for revenue, and we go to note 5. So note 5 here, revenue, and you can see IFRS 15. There's actually 115, 116 paragraphs in IFRS 15, and the disaggregation of revenue. So you break it down, what are the different line items you're getting revenue from, and you also might have it then how they're recognized at point in time or over a point in time. So it just good to give you an idea of where this commentary is coming from, and they also give you comments underneath of what this means. So it's nice to give that little green box just to make sense of it, because disclosure notes are one of the most important things in accounting standards. What has to be disclosed and what level of detail. All right. So have a look at Connolly textbook, chapter 4. It's a very good one in terms of revenue recognition. If you want to have a look at that IAS Plus, it's also useful, just giving you a summary of where this standard has come from and the key items in it. And then have a look at question pack 13. It does come up in the odd exam question, you will see it, and you'll see it some of the past papers, which are now in loop as well. And we will have a tutorial question on it next week to practice as well. All right, so that is finishing off this week's lectures on IFRS 15, a relatively new standard for international accounting standards, dealing with revenue recognition from contracts from customers.